Gold and silver just did the unthinkable. After smashing record highs and pulling millions of investors into the hype, both metals suddenly collapsed in a brutal sell-off that wiped out weeks of gains in hours. What shocked markets the most wasn't just the size of the drop, it was how fast it happened. Analysts who were calling for new all-time highs days earlier were caught completely off guard. So what really triggered this sudden meltdown? Was this a calculated institutional move, or the beginning of something much bigger? Because once you see what actually happened behind the scenes, the rally and the crash will make a lot more sense. Just days before the collapse, gold and silver were on an unstoppable run. Prices were climbing almost every session, smashing record levels and pulling in both retail traders and large institutions. Fear-driven money was pouring into precious metals as investors rushed to protect their wealth. Inflation worries, global uncertainty, and shaky confidence in traditional markets turned gold into the ultimate safe haven again. Silver followed even harder, delivering explosive gains that made headlines across financial media. It felt like the beginning of a new super cycle. Social platforms were flooded with predictions of even higher targets, and many believed this rally had only just started. But while the public was celebrating new highs, something very different was building beneath the surface, and it was about to flip the entire market upside down. Then it happened. Without warning, the market flipped. In just a single trading session, gold plunged by nearly double-digit percentages, marking its worst daily drop in over a decade. Silver didn't just fall, it collapsed. Prices crashed more than 15% in hours, triggering one of the sharpest single-day drops traders had seen in years. Trading screens turned red. Stop-loss orders started firing automatically. Liquidations piled up as leveraged positions were forced out of the market. Panic spread across forums, trading desks, and social media. What looked like unstoppable momentum days earlier suddenly turned into damage control. Investors who bought near the top watched profits disappear in real time. And while most people were trying to understand what just happened, the real reasons behind this meltdown were already unfolding quietly in the background. The first crack in the rally didn't come from panic. It came from profits. After months of non-stop gains, large investors and institutional traders were sitting on massive returns. And when prices reached extreme highs, many of them quietly decided it was time to cash out. Once the selling started, it created a domino effect. Early sellers locked in gains. That pushed prices slightly lower. Then more traders rushed to protect their profits before the move got worse. What began as smart money taking profits quickly turned into a wave of sell orders flooding the market. Algorithms picked up the momentum. Stop-loss levels were triggered. And suddenly, what looked like a healthy pullback turned into a full-scale reversal. But profit-taking alone doesn't explain how violent this crash became, because another powerful force hit the market at the exact same time.